Good morning. Today we start on the course name is Management and Financial Institution and Services, and course code is MGO 7123. And in this course there are 5 blocks are there, and today I will complete or discuss block 1. Block 1 name is introduction. Basically, in this block we will discuss the basic concept of financial institutions, and this block have 3 units: Unit 1, Unit 2, Unit 3. Unit 1 title is an introduction to financial system, components, financial system and economic development. Unit 2 is a financial intermediation, an overview of Indian financial system since 1951. And the Unit 3 title is Financial Sector Reforms since Liberalization 1991. So Unit 1, the title is an introduction to financial system, components, financial system and economic development. Basically, in this unit, discuss about the meaning of financial systems and its various components, and how financial system is very useful for economic development of any country. Actually, financial system is an important component for economic development of any state or any country. A financial system is a network of institutions, market, and instruments that facilitate the flow of funds from savers and borrowers. Basically, in any country, for development purpose, capital is more important. For industries, for the agricultural sector, for service sector, capital is more important for running or for starting any business. And now question come from where capital will be supplied. And so capital or financial system is such a system which discuss from where money will be supplied and to whom money will be supplied for increasing economic development of. So here we divide 2 sectors. So we can identify some people who basically save money, and we also identify some other class of people basically who needs money. So here people can be classified in 2 ways: savers and borrowers. So savers are basically the common people who have who have excess income, and in this case whatever money left after expenditure they want to save those money. So those people known as savers who are able to save some money after their expenditure. And borrowers are those class of people who basically needs money for starting or for running any business. And basically those people are entrepreneur or business class people. And the financial system is a mechanism who collect fund from savers and distribute that fund to borrowers. And they act as a intermediate institutions. And savings and allocation of fund in terms of investment is more important for development or growth of any state. So now I will discuss what are various components of financial system. So basically there are 3 type of basic component exist in financial system, like is financial institutions, financial market, financial instrument, and also financial services and various regulations introduced by the government. So financial institutions basically act as an intermediary who connect savers and borrowers. So in society, I said previously, so those people who save money, basically they generate capital, and borrowers are those money basically who needs capital for business purpose or for investment purpose. So financial institution as example we can take as commercial bank, insurance companies, mutual fund, non-banking financial companies. So basically they collect fund from the savers and they also provide fund in terms of loan to entrepreneurs who are the borrowers. And between this they also earn money in terms of interest. So basically, there is one interest gap exists. So those people who save money in a bank, so they also earn interest from bank because they save money in the bank or financial institutions. And those entrepreneurs who are borrowers who collect fund from banks or other financial institutions, they also provide interest to bank because for borrowings. And so there are interest gap present, and through this gap, bank or financial institution are money. Financial markets is the second category. So financial market basically is such a platform where financial assets are traded. So it means people or basically the government or industrialist or entrepreneurs, they collect fund from financial market, and many times they also invest their money in financial market also. So financial market can be classified into a money market and capital market. From both type of market, you can say entrepreneurs they can collect fund, but the difference is money market only exists for short term funds. It means entrepreneurs, if they want to take money or they collect money through borrowings, they borrow money for short period uh, from money market. So long period from long period fund they cannot collect from money market. Basically, money market deals with the short period fund. So it is possible that the entrepreneurs can collect money from for one night also in money market, and the government also use T-bills for collecting fund from money market. So basically, it for 90 days to 100. It means 90 days to 6 months. It means 3 to 6 months. It is possible that government can collect fund from money market by using the treasury bills. Capital market basically for the long-term loans or long-term borrowings. So those entrepreneurs who needs fund for long periods, they will approach to capital market for collecting fund. So as example, you can say about the stock markets. So from stock market also industrialists can collect fund for long period. So in financial market, it is possible that entrepreneurs can collect money for short period term also for the long period. Financial instruments. So what are various financial instruments actually exist in financial system? So basically financial instruments are tradable assets or paper claim that represent a financial. For example, we can say about the equity in stocks, we can say bond, we can say debenture, we can say about the derivatives and fixed deposits. So basically, equity and stocks deals with the ownership rights of any entrepreneur or company. It may be a reflection of ownership rights. It is possible, and bond and debenture basically deals with the agreement between parties through which those people who give money or invest money, they also earn a rate of interest. It is possible per annum they will get the rate of interest. So it is basically one type of agreement between the two parties, and one party will provide fund and other party basically receive that fund, and also that party will provide rate of interest to that person or institutions who provide the fund. In fixed deposit, basically, you can say common people use this fixed deposit term. Deposit in this case, that investors or common people, they also get rate of interest because they invest that money in bank for a certain time bound period. So these are various financial institutions exist in financial market. Financial services Basically, financial services are the specialized services provided by financial firms to manage money and risk. So actually financial service means various types of service provided by financial firm in terms of wealth management, in terms of investment banking, credit rating, insurance facilities. So those firms basically provide this service for managing capital and also for minimizing risk exist in financial markets. So many firms they approach to various financial institutions for managing their capital and also minimizing risk which exist in this market. At the same time, for controlling of financial market and for smooth running of financial market, government also have certain institutions who look after the work in financial market. Like as Reserve Bank of India, they also monitor the financial market, banking sectors, so that in banking sector always there will be stability exist and investors' money will be protected. At the same time, Security and Exchange Board of India (SEBI) was established in 1992. The main purpose of SEBI is to control the share markets and so that share market will work properly and investor right should be secured in share market. And for controlling the pension market, government introduced and insurance regulatory and development authority of India. Basically, it look after the insurance sectors and for look after the pension market or pension sector. Government also introduced separate institutions for look after the security fund of those people who invested money in pension sector. So these are the various components of financial systems. We will count the various financial institutions, the intermediary institutions. We can count various financial markets who will provide loan or credit. We count various financial instruments actually exist in financial market, and also we consider various types of regulatory body introduced by Government of India for smooth functioning of financial sector. Next, I'll discuss about the financial system and economic development. So we identify that the financial system is important for smooth running the economic activity of any country. At the same time, financial system is also important for economic development of any country. So here financial institutions basically indicate various types of financial intermediaries who interact between savers and borrowers. So first I say about the mobilization of savings. So financial systems or bank or other institutions, they always encourage people to save money. So common people, they can save money in bank and other financial institutions, and if they save money, then they also earn income in terms of the rate of interest. So rate of interest basically it is the per annum. And in this way, bank and other financial institution they have capital with them. So it is known as the capital creation. And here the common people also play a vital role to save their money in savings account in bank. And entrepreneurs they basically have the current account. And in current account there is no rate of interest. Next, capital formations. So financial system also play a vital role for capital formation in countries, especially here in developing or poor countries where there is shortage of capital exist. So bank and other financial institutions they always help for capital formation in any country through various savings account. So common people they can save money and bank can use this money for providing loan or fund to industries, agricultural sector, infrastructure development, and for business purpose. Efficient allocation of resources. Financial institutions also allocate resources to sectors with higher productivity and growth potential. So here, financial institution always monitor the sectors where there is more probability for higher growth and development. So in this case, financial institution always try to provide fund to those sectors where there is more possibility for future growth and development. Financial institution also assist or help for investment purpose. It means bank and financial markets always provide loan or credit to various organizations who want to expand their business. So entrepreneurs, if they want to invest money, they can collect money from various financial institutions. And at the same time, financial institutions also help for increasing economic growth and development by increasing production, increasing employment, increasing per capita income, and overall economic development of the country. Financial institutions also useful for expansion of financial market. And when financial market is expand, then it is very easy for industrialists to collect fund from financial market for investment purpose. Financial sector is also encourage entrepreneurships. So entrepreneur basically are those people who want to start new business, and for running new business they need capital. So many times entrepreneurs they do not have own fund. So in this case, bank and financial institutions they also play a vital role for providing fund to them in terms of loan or credit. And bank also earn interest when bank provide loan or credit to financial uh, people, or you can say those people who want to start business. It means entrepreneurs. At the same time, financial market also useful for increasing trade and commerce or business perspective in any country. So financial services such as banking, insurance, digital payment support domestic and international trade. And if in any country or society easily loan is available, then it is always helpful for entrepreneur to expand their business. So it also helpful for increasing trade and commerce in society or in country. Many times financial institutions like insurance companies also helpful for minimizing risk exist in financial market. Or you can say insurance companies also minimize risk to entrepreneurs who collect fund from financial market in terms of borrowings and credit. At the same time, financial institutions and financial market also helpful for economic development in terms of increasing employment opportunities. So you can assume that in any society or in any country where more number of bank and other financial institutions exist, so those institutions always provide fund to common people or entrepreneurs or those unemployed people who want to start business. So in this way, credit and borrowings always helpful for increasing business in society, and in this way it will helpful for increasing employment opportunity. So here we can easily identify that financial institutions play a vital role for increasing economic development and growth. In one side, financial institutions they increase savings in the society, and those people who save money and save this money in savings account in bank, they also earn income in terms of rate of interest. And at the same time, those entrepreneurs or unemployed people who want to start business, they also collect fund from bank and other financial institutions. And this fund and this capital helpful for expanding trade, business, and improving economic condition in the country. At the same time, it will helpful for reducing poverty and increasing employment opportunities. So in this way, financial institutions or financial market is very important for the development of economic growth and progress. So in this way, I have completed Unit 1. Basically, Unit 1 discusses a basic concept about financial market, various components, and how financial market is useful for increasing economic growth and development. Unit 2. So, Unit 2 discuss about the financial intermediation and also discuss about the an overview of Indian financial system since 1951. So, what mean by financial intermediations? I discussed previously. So, basically, financial intermediation is the process by which specialized institutions like bank, mutual fund, and insurance companies act as middlemen between savers and borrowers. So, savers are basically those people who save money in the bank, and borrowers are those people who basically collect money from bank and other financial institutions in terms of borrowing and credit. And these financial institutions are between, you can say, savers and borrowers. So they interconnect the savers with the borrowers, and these financial institutions they earn money in terms of rate of interest gap between savers and borrowers. And they also mobilize idle fund to investment in economic sectors like is agriculture, industry, and service sector. At the same time, these financial institutions also help for reducing risk in investment and also always try to maintaining liquidity of fund in society or in market. So we identified it. Financial intermediation basically are those institutions who interconnect savers with borrowers. So here I discuss various types of financial intermediaries which interconnect borrowers with savers, like as a commercial bank. So commercial bank basically accept retail deposits and provide loans and mortgages. So basically commercial bank in India, there are many commercial banks exist in India which directly controlled by the Reserve Bank of India. Like as you can renowned bank like State Bank of India, you can say UCO Bank, you can say Canara Bank and other banks are there. In India, they are the commercial bank and the scheduled commercial bank we can say, and their main duty is to collect deposits from common people and also provide a loan to industrialists and other business class people who need capital for running or starting new type of business. Investment banks and brokerage. Investment bank are such bank whose main duty is to provide fund to entrepreneur or industrialist. So basically, common people they cannot save money in investment bank, but common people they can save money in commercial bank, and investment bank basically provide fund to industrialist for investment purpose, and basically government use investment bank to provide fund to industrialist or for development purpose. Insurance and pension fund. Basically, uh, insurance sector are the sectors which try to reduce risk in financial sectors and also reduce the risk of life of common people. And people can save money in insurance sectors and also get benefit from insurance sector by minimizing risk exist of life or in business. And insurance sector basically they pull money from people in terms of premium and contribute to cover future liabilities or retirement risk. So common example in insurance sector you can say about life insurance. You can say that in India life insurance sector exists, and this sector basically look after for reducing risk of life of common people, and those people who invest to save money in insurance sector they are also able to get good return in future. And pension fund is also same. So common people or employed people they can save money in a pension fund, and in this case in future they also get good return. And government of India have public private fund pension fund also. So where common people also can invest money, and at the same time they can get rate of interest. Mutual and hedge fund. So mutual fund basically is a way through which people can invest money in share market, and also they can earn good return. But in mutual fund investment is subject to market risk. So if share market there is good condition in share market, if Sensex increase, then it is possible that those people who invest money in share market through a mutual fund, they also can earn good return. And basically, mutual fund pool money from multiple investors, and they also try to minimize risk, because in India, mutual fund market is controlled by various big corporations, and they also hire good expert who basically look after the investment of fund in share markets, and they always try to minimize risk exist for investment in share market. But still, investment in mutual fund bear risk on the basis of market condition. How the process work? So basically, that the financial institutions, if you see the process, there are three steps exist. First step is the capital sources. So it basically means from where capital will be collected. So intermediaries basically means the bank and other financial institutions. They collect surplus capital from individuals and businesses in the form of deposits, premium, and investments. So in this case, capital sourcing means collecting the capital from common people or investors, those people who want to invest money in financial institutions. Next duty after collections is how this money will be distributed, so that the bank also earn return. So in which area they will distribute this fund. So bank always try to distribute in those areas where risk is less. And the third one is the capital allocations, means actual distribution of fund in terms of loans or borrowings to investors. So these are the three steps for introductions of financial institutions for providing fund to common people or industrialists. So first step is collecting fund. Second step is prepare the plan in which area fund will be allocated, and third one is the actual allocation of the fund. An overview. Next is an overview of Indian financial system since 1951. So Indian financial systems is changed day by day. So after getting independence in 1947, so Indian financial system is never set. Indian financial system is always changing on the basis of changing of market and changing of the international condition. At the same time, also changing of the economic condition of the nation. So when India got independence, after that, Indian financial system basically controlled by the uh, public sector, government sector. So government basically try to increase its influence or role in financial sectors. So after independence in India, it has been found that there are many banks and financial institutions run by the private sectors. Then government try to take over those private firms or financial institutions and convert those private bank in terms of the government bank. So basically, after independence, the main agenda of a government is to expand role of government in Indian financial system. But situation was changed after 1990. So after 1990, Indian government introduced liberalization policy. It was liberalization, privatization, globalization policy, and thereafter, Indian financial system also changed. So after that, Indian government tried to encourage private sector to play a role in Indian financial system, and the government tried to reduce its role in financial system. So after 1990, we see more role of private sector in Indian financial system. Third, you can say changes we basically observe in after 2015, and currently also we are observing that the Indian financial system is now more digital acceptance, and Indian financial system are now using more financial technology and new innovations. So in this way, we can divide Indian financial system in three parts: public sector era between 1951 to 1990, liberalization era between 1991 to 2014, and digital and global integration era, which arises after 2015. So first stage is the public sector era between 1951 to 1990. So here we observe that Indian government nationalized Reserve Bank of India in 1949, and we also observe that setup of State Bank of India as a government bank in 1955, and previous name of State Bank of India, it was Empirical Bank of India, and Empirical Bank of India was formed by merge of three banks. It is the Provincial Bank of Bombay, Provincial Bank of Bengal, and Provincial Bank of Madras. So these three banks merged and formed Empirical Bank of India, and thereafter this bank was converted as State Bank of India in 1955 as government bank. But major changes in Indian banking sector happened or occurred in 1969 when government nationalized 14 private banks, and in 1980 again government nationalized 6 private banks in government bank. So in this way, in 1980 we have 20 nationalized banks. So after independence, government basically look after increasing role of government in banking sector. There are many reasons behind this, because after independence, government saw that private bank cannot actively involved for providing loan to farmers and other weaker section peoples, and the society or people are not getting more benefit from the private sector bank. So this is the reasons of government, and government think that if those bank, private sector bank convert in government bank, then those bank will work more for welfare of the common people and welfare of the farmers. It is known as a nationalizations of bank in India after independence. Second one is the creation of development financial institutions. So government also set up some development financial institutions whose duty is to provide fund to industries for industrializations, for development of the rural areas and agriculture, and also for providing fund to those organizations who produce product for exporting purpose. And for these reasons, government set up those institutions, and they basically provide the long-term fund for agriculture and industrial development. So in example, we can say about the Industrial Financial Corporation of India, which was formed in 1948. Indian Development Bank of India, Industrial Development Bank of India, which was formed in 1964. National Bank of Agriculture and Rural Development, in short it is known as NABARD, which was formed in 1982. Exim Bank, which was formed in 1982. So basically IFCI and IDBI, they basically provide loan to industrial sector, and they provide loan for long term for industrial development in the country. And NABARD basically provide long term loan for agriculture and rural development purpose. And Exim Bank full name is Export. It's basically Export Import Bank. So this bank basically provide loan to those industries or organizations who are involved in international trade, or you can say those firms who produce product and services, who is basically export to other countries. So in this way, government set up various development financial institutions for agriculture and industrial development. At the same time, government also set up the Life Insurance Corporation (LIC) in 1956 and also general insurance for look after the growth of insurance sector. So LIC basically look after the insurance of human insurance, insurance to people, and general insurance basically look after non-human insurance like insurance of car, housing, assets, infrastructure, basically look after by the general insurance. And LSC and general insurance is also controlled by the government. And majority of share of LIC and general insurance still in the hand of the government. Liberalization era, which started after 1990. So basically, in India, the economic conditions after 1980 to 1990 was not good. Indian government faced financial crisis during this period, and the Indian government think that financial sector should be modified or should be changed so that it will increase growth. And government also identify various government controlled financial institutions, they are facing loss. And government identified that our controlling of government in financial market is hampering its natural growth. And so government identified that government will open this financial sector to various private organizations. It means as a privatizations, and at the same time, government also allow various foreign institutions also for investing money in Indian financial sector. So I discuss some points here, like as the financial sector reforms. So in India, the in banking sector, there are many problems facing by the banking sectors or intermediary financial institutions. So one most important problem is the non-performing assets (NPA). So NPA volume is increasing in nationalized bank, and government of India form a committee. It is known as a Narasimhan committee, and that committee also provide recommendations for changing in Indian banking sectors. And this committee also identified that there should be more autonomy power should be given to banking sector so they can individually perform well. And in this case, they also suggested interest rate should be deregulated. So it means basically that currently how much interest will provide by bank to common people who save money in their account, savings account. It not uniform. It depends on bank. Some bank it is possible they can give higher rate of interest, and some bank it is possible they may give them some less rate of interest. But previously, before 1991, it was uniform, same. But this Narasimhan committee suggested interest rate should be deregulated. Government should not directly control the rate of interest in the bank, and at the same time, there should be reduced mandatory liquidity ratios (CRR) and SLR to bank. So CRR basically means cash reserve ratio, and SLR means statutory liquidity ratio. Those CRR basically means every bank, every commercial bank should save certain proportion of the deposit to RBI in Federal Bank. So this is known as a CRR. Basically, it is 3%. So it means that whatever deposits any commercial bank have, so basically on an average you can say that 3% of their deposit they should save to RBI. And SLR, statutory liquidity ratio, basically means that every commercial bank should keep some money in cash box. So for providing fund to common people who want to withdraw money from bank. So basically, for running daily withdrawal activities, every commercial bank should keep certain proportion of the deposit in cash box. It is known as the SLR. So SLR on an average, it is the 25% of deposits. It means 25% of deposit commercial bank always try to keep in cash box, but it is not fixed. This percentage is not fixed. It may be increased or it may be decreased. It decided by the RBI. And the government also introduced some policies like how much cash or how financial stability of banking sector will be increased. Second, reform in capital market regulators. At the same time, in bank, after 1991, government also allowed private bank to operate in India. But previously, government totally controlled the activity of the private bank in India. But after 1991, government encouraged new private bank for running their economic activities. And also government encourages private sector role in insurance sectors, and many foreign insurance company also entered in India after 1991. So before 91, government have monopoly power in banking sector, insurance sectors, but after 1991, private sector's role is increasing continuously. And at the same time, for observing share markets or stock market, government introduced SEBI in 1988 and granted it statutory power in 1992. Basically, we can say that after 1992, SEBI basically worked properly. Third stage, we can identify this is the digital and global integration era. So this is means after 2015. Currently, we observe that financial sector changed rapidly, and we observe that new technologies, new schemes introduced in Indian financial sectors. It is known as a fintech. It means the financial technology introducing, and the online payment system role is increasing in India, and also other authentications. This policy introduced in banking sectors. So Indian banking sectors, insurance sectors, all are changing rapidly. In digital changes occur after 2025. So in this way, I've completed Unit 2. Basically, Unit 2 and discuss about changes in Indian financial sector after independence. Unit 3 basically discuss financial sector reforms since liberalization 1991. So, what type of reform basically introduced in Indian financial sector after 1991? I have written some points. Whatever changes happened, like we can say that after 1991, Indian government accepted many recommendations suggested by the Narasimhan Committee, and Indian government tried to increase productivity and profitability of banking sector by adopting suggestions given by the National Committee, and the special suggestions which are provided by this committee for increasing autonomy power of Indian banking sector. It means banking sector reforms introduced after 1991, and at the same time, SLR percentage also reduced so that bank have more capital with them, and this capital will be used for investment purpose, which increase economic growth and development of the country. So I said previously that SLR basically indicate the percentage of deposit every commercial bank keep in cash box. It is known as a statutory liquidity ratio, cash box. So I give one simple example. Suppose if 100 rupees people save in bank, if 100 rupees, so suppose previously 40 SLR rate is 40%. It means 40 rupees should be kept in the cash box. So remaining is 100 minus 40 is 60. So 60 rupees bank can use for providing loan or credit purpose to industrialists or businessmen or entrepreneurs. So if SRL is declined, suppose for 40% to currently it is the 25%. It means out of 100 rupees now 20 rupees will be keep in cash box. It means now 75 rupees bank will provide loan. So in this way, loan providing capacity of commercial bank increase if SLR rate is declined. So third is regarding the cash reserve ratio CRR. So after 1991, CRR rate is also declined. So currently it is 2.5%, nearly 3% it is. So if CRR rate increase, then loan providing capacity of commercial bank decline. And if CRR rate decline, then loan providing capacity of commercial bank will be increase. So after 1991, both declined. SLR rate also declined, and CRR rate also declined. And at the same time, government introduced policy of deregulation of interest rate. So commercial bank will provide rate of interest on the basis of its financial capacity. So in India also currently some commercial bank, if people save money, they will give some higher rate of interest than the other commercial bank. And at the same time, after 1991, government allowed various private sector bank to operate in Indian banking sector. We can say like ICICI Bank, HDFC Bank, Axis Bank, they also allow and operate in India, and also various foreign bank also they also entered in India, like the Citibank, they also uh, enter in Indian financial sector. But before 1981, government do not have any permission to foreign bank to operate in India. But after 91, when India government introduced liberalization policy, they allow foreign bank also to operate. At the same time, government also changed various norms, norms for controlling the financial sectors. So norms now more simplified, so that the private sector will be work properly, and they can increase their profitability and financial stability. At the same time, government also try to reduce non-performing assets in banking sector for increasing financial stability of banking sector. So non-performing assets are basically known as NPA. So NPA basically means suppose bank provide loan to any industrialist or any persons, and if suppose 90 days that industry or any person unable to repay the money. So in this case, that will call as a non-performing assets. So non-performing assets is also known as a bad loans. And at the same time, RBI also changed the supervising capacity, and new roles introduced so that bank will perform well and also operate freely for increasing their financial stability. At the same time, government also introduced, I said previously, that Security and Exchange Board of India, and this basically look after the operational work of the stock exchange, and also look after the safetiness of investors who invest money in share market, and also government encourage electronic trading in Indian financial sectors. Government also introduced Insurance Regulatory and Development Authority of India for observing the functioning of insurance, industrial insurance sectors, so that insurance sector will work smoothly, and those people who save money or invest money in insurance sectors, their money will be safe. Mutual fund reforms in India currently also, private and foreign mutual fund are operating in India, and Indian people also can invest money in private and foreign mutual fund organization. And Indian government after 91 also allowing foreign exchange departments and foreign exchange organizations who look after basically import and export and transaction of foreign currencies. And government always try to simplify the uses of foreign currencies in India, so that financial sector or business class people they can operate their work properly. And in India also currently that the exchange rate of Indian currency is floatable. Uh, it means exchange rate of Indian currency with the other countries' currency is changing. Every day it is changing. At the same time, after 1991, government more focus on digital banking. So in this case, government think how banking sector will be more expand in rural areas, and so government expand the ATM services, internet banking, mobile banking facility, digital payment systems, so that the rural people also get benefit of it. And government also strengthen the capacity of payment system in terms of RTGS, NEFT, UPI, so that people can easily transfer their money from one place to another place. Nowadays, UPI system is more popular among the common people because it is very simple for transferring money from one place to another place or from one person account to another person account. At the same time, after 1991, we observe more disinvestment and privatization activities. So, disinvestment basically means selling share of a government-owned company or organizations or enterprise in open market. So, in this case, simply you can say that government reduce their ownership rights from any government-owned organizations, or you can say government allow private sector to enter in ownership rights of government enterprise or organizations. And also government try to increasing transparency and accountability in financial sector by introducing various regulatory body. So in this way, we identified that Indian financial sector is not rigid. Indian financial sector is changing, and especially we observe after 1991, Indian financial sector is rapidly changed. And we observe that after 1991, in Indian financial sector, there is more role of the private sectors. And before 91, we observe more role of government sector or public sector in Indian financial sector. And after 2015, we observed that Indian financial system moved towards more digital reforms. And this is the agenda of Indian government also, digitalizations of Indian financial sector, so that there is more transparency in financial activities and more security for common people who invest money in Indian financial sector. So in this way, I completed unit 3. So unit 3 is very simple, very small. So basically, unit 3 discuss about the financial sector reforms in India since 1991. So I have written some questions like definition of financial sectors, or what is meant by the financial intermediations, or you can say what is the role of Indian financial sectors for economic growth and development, or you can say in which way Indian financial sectors change after 1991. So in next class, next Saturday, I will discuss block 2, and block 2 title is financial markets and capital market. So in block 2, I'll discuss about the financial markets, various type activities, role of the commercial bank or role of central bank of India, how money market is working, capital market is working, and what is meant by the primary and secondary markets. So all those things I'll discuss in next class in block 2. So thank you. So if you have any questions, you can ask to me, and at the same time, I have also given my email and phone number in first slide, so you also can communicate. So thank you, and in next class I will discuss the block 2.